Dear ladies and gentlemen, participants of the World Investor Week, we welcome you. My name is Almas Jolmanov and I will be moderating this webinar. Some technical announcements. You may ask your questions through the chat function in your navigation panel. We will collect all the questions and respond to them in the end of the webinar. Translation into English, Kazakh, and Russian will be available. You may choose the language interpretation button, and which is indicated as the globe icon in the navigation panel. With this introduction, it is my pleasure to introduce the two speakers of today's webinar. Mr. Razaak Busari is the head of Authorization Division of the Astana Financial Services Authority. Raz is a seasoned regulator with over 20 years of financial services and regulatory experience. Prior to moving to Kazakhstan, he worked with the leading financial services regulators such as the Financial Services Authority of United Kingdom, the Qatar Financial Center Regulatory Authority, and Cayman Islands Monetary Authority. Raz holds various professional qualifications in financial planning, mortgage advice and practice, compliance, anti-money laundering, and Islamic banking and insurance. He's also a certified anti-money laundering specialist and sits on the board of the ACAMS Eurasia chapter. Raz is also a fellow of the Chartered Management Institute based in UK. Raz holds a Bachelor of Law degree and Master of Business degree from the United Kingdom universities. Our second speaker is Ms. Ainur Alpys. She's a Senior Associate at the Strategy and Policy Division of the Astana Financial Services Authority. Ainur has over 5 years of experience in regulation of financial services in the field of authorization, prudential regulation, policy and strategy. Ainur holds the master's degree in mathematical finance from the Boston University. With this introduction, I'm pleased to hand over to our first speaker, Mr. Busari, who will talk about understanding basics of investing. Raz, the floor is yours. Raz, you are online. You may speak now.
Okay. Good morning, everyone. Can you see my screen?
Yes.
Okay, brilliant. Well, good morning, good afternoon, or good evening, wherever you are, joining us from all over the world. I'm delighted to be here to talk to you again about the basics of investing under the auspices of the World Investor Week. And today I've got various hints and tips to share with you about how to be a smart investor and the basics of investing. Okay. So that's just a bit about me. My name is Razaak Busari, as introduced, and I head the Authorizations Division within AFSA. I joined just over 2 years ago, the 1st of October 2019. What I'll be discussing today is...
Raz, do you want to share your screen?
I thought I have. Can you not see it? Sorry.
Nope.
Okay, let me just do that again. Can you see it now?
Yes, perfect.
Oh, okay. I'll start from the beginning. So the topic for today is finance for all, know how to be a smart investor, and I'll be discussing the basics of investing or understanding the basics of investing. And under that, I'll be discussing what is investing, the basic difference between investing, trading, and saving, because they all have the same connotation, but they're quite different. I'll illustrate how savings and money and investments grow, and then I'll discuss the various types of investments, just the basics, a few tips for beginner investors, and then I'll talk about financial advice and investments, And a few of the mistakes people make in terms of the herd mentality, avoiding things like FOMO and YOLO. So, that's basically fear of missing out, where you hear that, oh, bro, everybody's into cryptos. I don't want to miss out. So people get into this fear of missing out and they make mistakes. YOLO means you only live once, where people then get reckless. And you've seen this with GameStop, AMC, and various other stocks and shares, where people just think, well, what's the worst that can happen? You can only live once. We'll go for it. And after that, I'll open the floor for any questions you might have. Okay, the basic difference is investing involves committing money in order to earn a financial return. So it essentially means you're investing money to achieve whatever financial goal you have. It tends to be over the long term. So I might be investing over the next 15 years to send my kids to school or university. Thank God my kids have left university, but I did have to invest quite a lot for that. And it's one of those things where you start saving and investing for at least 5, 10 different years to, have your university fund available. Now, in terms of saving is where you just put money aside. It tends to be in a deposit account, it's guaranteed by the bank, and you're lucky if you get a little interest on your savings. As you all know, we're in a very, very, very low interest climate, so you barely get anything on your savings these days. However, saving is a good strategy because the money you save could also be used to make certain investments depending on how long you want to save that money for. Now, as I said, savings are guaranteed, but investments are not. Trading is what you do on a day-to-day basis. You can swing trade daily, you can trade over months, you can trade over years, depending on what your strategy is. And we'll get into that in a few more minutes. Now, this is just an illustration of the difference between just keeping your money in cash, saving in a bank account. So the first one is where you put your money under the mattress. And this is an illustration for where you've saved $20,000 over 30 years, looking at what will happen to your money. So the first one is where you put your 20,000 under your mattress for 30 years. The second one is where the same 20,000 in a bank account with 2% interest. And the third illustration is where you actually invest that 20,000 over 30 years in various investments. Now, what you find is with the first one, where you've kept your 20,000 under the mattress for 30 years, all you get back will be exactly that 20,000 that you put under the mattress. The only thing you might get, if you're lucky, is it might gather a bit of dust under the mattress, depending on how well you clean your house. But it might gather dust, nothing else. If you put that same 20,000 in a bank account that gives you 2% over that 30 years, you'll get 36,337 back. So you have made a lot more than the person who's just stuck that money under the mattress. However, if you were to invest the same 20,000 over 30 years in various investments, say stocks and shares, exchange traded funds, bonds, whatever, and you have a portfolio of investments that's giving you a 5.48 annual return, you will receive 99,113. So look at that massive difference between putting your money under the mattress, saving it in a bank account, and investing. However, the big difference is investing is not guaranteed. The 5.48 annual return might be something where you make 1% one year, you make 9% the other year, you lose money in the third year, you then make 20%. It goes in different patterns and nothing's guaranteed. that means when you're investing, you have to make sure you look at what your attitude to risk is. And again, I'll come to that in a minute. The next slide looks at the four main types of investments. Now, you hear a lot of fancy words, derivatives and exchange traded funds, exchange traded notes, options, futures. When you break down investments, ultimately, they break down into four main categories. You've got cash, which is your everyday bank account. You could put it in a high interest savings account. You could use term deposits. And again, these tend to be safe. Most banks are guaranteed by the government of the day, by the central bank, as as the main banker. And again, it's sorry.
Your presentation is not on full screen.
F5, okay. Okay, just.
Thank you.
Okay, so again, cash is guaranteed or tends to be guaranteed. The problem with cash, though, is it can be eroded due to inflation. So if you go back to the slide where I talked about keeping 20,000 under your mattress for 30 years, you will get your 20,000 back. But guess what? In 30 years, what that 20,000 could buy, it won't be what it could have bought 30 years ago, because inflation is 1% or 2%. Can you imagine how much that's eroded your 20,000? So there are downsides and there are upsides to saving in cash, especially when it comes to having cash. The phrase is cash is king, especially where you're in a market where things are going down and you can buy stocks and shares quite cheaply. The next one is bonds, or what's known as fixed interest. Again, this is effectively a loan taken out by the government, and where they're willing to pay investors with a promise of a repayment. And a typical one is your treasury bonds in the US, where they come with a fixed rate or maturity over 10 to 30 years. Again, people like these because they tend to be guaranteed unless the government itself fails. Very, very few governments default on bonds, but it has happened. But they do offer a lot more than your normal bank accounts. And because they're government guaranteed, a lot of people use these. And especially when it comes to diversifying their investments, a bit of cash, a bit of, bonds or fixed interest, and other investments. Okay. You also have property, or, also referred to as real estate. And it's nice to invest in property because they're more fixed assets that you can invest in long term, and you can receive an income if you rent it out. It could gain in equity depending on whether you get a mortgage and how much you've paid. The price of the property goes up. You can sell it for a huge profit. So people do like property. Again, the problem with property is it's not liquid. If you are short of cash, it's not something you could just sell within a day or two. You have to find a buyer, find lawyers, do the conveyancing, and it may take time before you can actually sell the property. Now, some of you might remember the financial crisis of 2007, 2008. And there's a typical example of a huge bank in the UK called, I think it was Northern Rock. It's called Northern Rock. And what happened was they lent a lot of money based on the subprime financial mortgage industry. And a lot of their clients were taking money to buy mortgages, and that money was then invested in the subprime market. And when the financial crisis came, Northern Rock had loads of assets. It had loads of these mortgages, loads of properties, but it was unable to raise capital in the capital markets. It became illiquid. And eventually there was a huge run on the bank where, there were queues like 2 streets long, people trying to get their money back because they heard the bank had failed, it had run out of money, and eventually the government had to bail Northern Rock out. And by 2012, it, sold off all its remaining assets. I think it sold them to Virgin Money. And the final type is stocks or shares. Now, these are considered growth investments, and they can help you grow the original value of your investment. And you could do the short term, medium term, or long term. However, to really get the benefit of shares, you need to keep them for a number of years, at least medium to long term, and do what's known as dollar cost averaging. So you can dollar cost average over various months. So you buy a share when it goes down. What you want to do is avoid buying shares when the prices are up. You look for when they're red, then you buy, hold on to them, and sell when they're green. You do not want to get emotionally attached too much to a share. I've done that in the past, where, I love Facebook, I love this, I'm going to keep the shares forever. No, if you've made a decent profit, you you sell, you wait for it to go down again, and you can buy more. If it doesn't go down, you move on, you buy something else. One thing you'd never do is get too emotional with shares. Okay, now I'm going to go over a few tips. And I know a lot of people listening to this are probably avid investors, but even this, you can pick up a few things because even as an avid investor, we still make the same mistakes. So first thing first is you need to acquire financial intelligence. And during the opening remarks, both speakers talked about how important it is to understand what you're doing. Yes, listen to a financial advisor or consult a financial advisor if you have to, but also read up on what you're investing in. Don't just take it for face value because some celebrity has said this on YouTube or on TikTok or on their Instagram. The celebrities paid to tell you that. They don't give they don't care what you do or whether you make money or lose money. They've been told to tell you that. So do your own research. And I've told a few friends and colleagues this. I, as an investor, have always just done things like cash or treasury bonds and property, never really done stocks and shares until maybe a couple of years ago. And one of my friends, he's an avid investor. We were chatting one day and he was telling me about this new property he had just bought. So I was like, wow, it sounds good. And he goes, oh yeah, I just used the dividends from my stock. I was like, what? How big is your portfolio? If you're just using your dividends to buy a property, you must be worth millions. And he just laughed. So he said, yeah, he's got quite a lot in stocks and shares, and that's how he was able to buy this property. So I was saying to him, could you please tell me how to invest in stocks and shares? And he said, no, I can't. You have to do your own research. Initially, I was really upset. I was like, you're supposed to be my friend. Don't you want me to make money and all that? But after we got off the phone, I started reading up and I started doing my own research. And I was amazed. First few months, I made huge losses because I was emotional. As soon as I saw a bit of red on any of my shares, I thought, oh my God, what am I doing? And I quickly sold. But I got the hang of it. And within a couple of years, I'm not an expert, but at least I'm not doing too badly. So do your own research, acquire financial intelligence. Second thing, start investing. It's never too late. Some people might, I'm 50, I'm 60, I can't invest now, or I don't have enough money, I don't have enough time. Any excuse. Investing is like a moving train. So if you miss one stop or you miss one station, guess what? Wait for the train at the next station. Just make sure that you board this train because it's ever moving and it's never too late to get onto it, but you need to start investing. And it's always nice to start early. My son recently turned 21. And one of the things I said to him is, okay, for your 21st birthday, what I'm going to do is open a broker account for you. I'm going to deposit a certain amount in there. You're going to match it out of your money because you need to have skin in the game. And we're going to buy some stocks and shares. And that was his 21st birthday because I wanted him to start early. I wish someone had told me about investing when I was 21. Again, know what you're investing for. What is the purpose? Are you just doing this because, oh, everyone else is investing in cryptos? Oh, let me do it. Are you investing to buy a house? Are you investing to, for your kids' universities? You need to know the reason you're investing. Understand the risk you're taking. That's the key. The investments have to match your attitude to risk. What you find is a lot of financial advisors will give you something to tick or a questionnaire of 1 to 10. And then if you tick 5, they will say, oh, well, you've got a medium risk. That's absolute rubbish. The only way you can really determine someone's real attitude to risk is by understanding their ability to absorb loss. So if you're one of these people who you cannot even afford to lose a penny out of your money, guess what? Go into a fixed interest, go into bonds, go into treasury bills, keep your money in cash because you will lose some money in stocks and shares. However, you might also make some money, but you need to understand the risk you're taking. Do your own research. Another key element is diversify your investments. Do not just put all your eggs in one basket. A bit of cash, fixed interest bonds, stocks and shares, property, mix it up. Even your properties shouldn't be in one country if you can do something differently. Invest in the UK, invest in Kazakhstan, invest wherever you can. So I try as much as possible to diversify my investments, properties in different countries, a bit of crypto, stocks and shares, even different brokers. I don't use one broker. Diversify your investments. When one is not doing great, the other ones might be doing great. That way you do not put all your eggs in one basket. Again, invest for the long term. It's a marathon, not a sprint. I repeat that again, it's a marathon, not a sprint. So take your time, invest for the long term, and watch your money grow. See the effects of compound interest. Watch out for high fees. Now, a lot of financial advisors, a lot of investments might have fees. What are these fees? How have they been disclosed to you? And I'm sure when my colleague Ainur talks about investing from a regulatory perspective, she will talk about this in a bit more detail. But you need to make sure they've disclosed this to you and you know the effect it has on your investments. Exchange traded funds are great. I do have 1 or 2 exchange traded funds just because it gives me a basket of investments that it would cost me too much money to invest in if I was to buy each stock and share. But with exchange traded funds, you're already paying the fund manager certain amounts. So I just do my own investments. I do my own research. But if you do not have the time, you can invest in exchange traded funds, but watch for high fees. Okay, consider how much time you can put into investing. What time do you have to do your research? If you can't do your own research or you're too lazy, use a financial advisor. Go into exchange traded funds or something like that. Again, how long are you investing for? Make an investment plan and stick to it. Do not get freaked out just because you've lost money over a day or a week. I wake up some days, look at my investments, and it's all red. But if the fundamentals of those companies have not changed, you only lose your money if you panic and sell the shares. They're just paper losses. until you actually cash in. So do not make, do not change, stick to your investment plan if you believe in it. Another big one is avoiding lifestyle creep. Lifestyle creep is where you make a bit of money and all of a sudden, those sardines you were eating no longer taste good. You now want to eat caviar. Your cheap bottle of wine no longer tastes good. You now want to drink champagne. And because of your lifestyle, you start living big. You forget about investments. You buy the most expensive car. And as you earn more, you let your lifestyle creep up on you. It really stops people from investing because they now think, oh, because I'm so and so, people have to see me in this car. I've got to be seen in these nightclubs. I've got to be seen in these restaurants. And they let their lifestyle creep up on them. Please try and avoid that if you want to be a good investor. I'm not saying don't live a good life. Of course you must. Now, financial advice and investments. One of the things I also want to point out is the need to have what's known as holistic financial advice. It's not just about stocks and shares or keeping money in a bank account, because one size does not fit all. You have to look at the whole picture. Invest in your health. Invest in your family. Do you have life insurance, for example? What would happen if you've got young kids and God forbid something was to happen to you as the main breadwinner? Do you have life insurance? Do you have health insurance? What happens if you fall sick and you can no longer earn an income? What have you done for your retirement? How are you protecting your wealth? Have you got an inheritance tax planning? So when you speak to financial advisors or look at your own financial advice, look at it from a holistic point of view. Invest in your health. Now, again, there's a big difference between wants and needs. A lot of time, we go by our wants rather than our needs. And it's like, oh, well, I want this, I want that, yeah. And I joke with my kids sometimes when they're, oh, Dad, I want this and this. I said, well, I wanted Naomi Campbell, but I ended up with your mom. You don't always get what you want. It's just the way things work. So difference between wants and needs, what do you really need? Do you have to buy everything you see? Maybe not. One of the things I mentioned before was understanding your attitude to risk. And again, this whole concept about your real attitude to risk is determined by your ability to absorb loss, not by you just ticking a 5 or 6 or 7 on a scale of 1 to 10. How much can you really, lose? Now, there's also what I call the dog mantra or the sniff test. And what I mean by that is, if something looks like a dog, barks like a dog, and smells like a dog, guess what? It is a dog. Beware of dogs when it comes to investments. If it doesn't smell well, it doesn't smell good, it doesn't smell right, leave it. If you look at it and think, that's too good to be true, it probably is too good to be true. Someone all of a sudden starts promising you 50% returns on some investment you've never heard of. You think, well, if it was that great, everyone else would be doing it. Why would I? So if it just, if it looks like a dog and smells like a dog, it probably is a dog. Just leave it out. Don't do it. And I think this might be my final slide. One of the things I also would say is avoid the herd mentality. The herd mentality is for cows and sheep, where they just follow each other around in a herd and do whatever the leader does. You need to do things that match your attitude to risk, match your wants and needs, or really your needs, and what you're planning for. Don't just do things because everyone else wants to. What are you trying to achieve? And with this, you need to beware of the fear of missing out. Sometimes I look at a share and, it's already gone up. An event happened, it's merged, or it's just, the Federal Drugs Agency have just signed off on a new innovation or new drug they've developed, and the shares shoot up. And I think, how did I miss that? But you don't want to jump up on it because you're buying it at a high price. Guess what? It might come down after people stop getting excited. So please do not get into this fear of missing out. If you've missed something, guess what? Another stock will come along, another opportunity will come up, and eventually what goes up comes down. Wait for it to come down, and then you can buy it and wait for it to go back up again. And this reckless, you've got the Ready Army, you've got Robin Hood. With the COVID-19 and working remotely, a lot of people have started investing, and you've got this Red Brigade where they've got this you only live once kind of attitude. They'll invest in anything that, is a meme stock, hoping that they will make money. And you can make loads of money on meme stocks, but guess what? You could also lose a lot of money. So avoid this attitude of you only live once when it comes to investing. Now, the final comment I'm going to make here is a comment by Warren Buffett, a comment he made in 1986. Warren Buffett is a world-renowned investor. He owns Berkshire Hathaway. And what he said, one of his final comments that a lot of financial analysts and investors use is, be fearful when others are greedy, and greedy when others are fearful. So, and a typical example is your cryptos or other investments like that, where the new innovations, everyone's being greedy because they're jumping in because they think loads of people are making money. I don't want to miss out. That's the time you really need to be fearful and watch is going on. Then you need to be greedy when others are being fearful. This is when the markets all turn red and everyone's panicking. Oh, the market's in a bear market. Well, when the market's in a bear market, maybe that's the best time for you to pick up stocks you've been eyeing for a long time because they've now gone down. You can buy them cheaply. So be greedy when others are being fearful. And that's my concluding statement. Thank you so much for listening to me. And I will take questions later when I think after Ainur's presentation. Thank you very much.
Thank you, Raz. I think that these were very informative and fundamental concepts that every new investor must know before considering investments. Our next speaker is Ainur Alpys, who will talk about fundamentals of investing from the regulatory standpoint. In the interest of time, Ainur, I'll ask you to be shorter. So with that, Ainur, I hand over to you. I think you're on mute. Still on mute?
Hello?
Yes, good.
Yeah, great. So you have just heard from my colleague the main key messages from the World Investor Week. So regarding conducting research on a product before investing, understanding the risks involved, and recognizing the compound interest and importance of diversification. And also, Raz talked about how it's important to plan and invest according to the future needs and goals, long-term, regular, diversified investment, and unexpected challenges. So in my presentation, I will talk about what it is to be licensed. So the first message is how to check whether investment professional is licensed. What should you know as an investor before dealing with investment professional? What are the requirements for getting a license? What does it mean to be regulated? The ongoing conduct requirements, and how the AFSA supports public trust and transparency. When we say that investment profession is licensed, why it is so important? So I wanted to pay attention to the main two prohibitions in the financial services framework regulations in the AFSA. So the first one is a general prohibition. So a center participant must not carry on a regular activity, market activity, or ancillary service unless it is licensed to do so by the AFSA. And another prohibition is in relation to the individuals. So individuals undertaking key regulated activities within the firm must also be approved by the AFSA. In here, we need to understand what constitutes these financial services, regulated and market activities. There are two sets of criteria. The first one is a range of investments. Those are shares, bonds, contracts of insurance, etc., and a range of activities for which the professional is licensed. For example, dealing in investments, managing investments, advising on investments, etc. So when a firm is performing a licensed activity, he performs a licensed activity in relation to these specified investments. And then that firm needs to be licensed, hence requires authorization. So here you can easily see the AFSA website and the link to the public register, where you can identify what kind of activities a service provider is licensed for, details of its license, and key people approved within the firm by AFSA. If a firm shows you only the registration status saying that it is an AFSA participant, so you can see it on the screen, for example, and offers you some additional financial and or ancillary services, please ask a question. Are you a licensed firm? Or what kind of activities are in your license? Just registration as an AFSA participant, obtaining this status is not enough to perform licensed activities for market activities, for ancillary services, and for regulated activities. So if an entity is performing a licensed activity, it requires authorization in addition to its corporate registration. Before authorizing a firm, AFSA undertakes an assessment in accordance with its rules and regulations, and sees whether the firm meets these threshold conditions. Appropriate and adequate financial and non-financial resources. The firm must have the right people, financial resources, systems and controls to deliver the products and services. Fitness and propriety in terms of controllers, governance structure, key individuals that perform controlled and designated functions, appropriate business model. So general fitness and propriety considerations. The firm should also have a well-thought compliance framework, a clear definition of conduct risks, and how it is within the firm controls and establish systems for mitigating this risk. And it is important to understand that a licensed firm needs to meet all the regulatory requirements at all times. So this is not only at the licensing stage, but throughout the operation of the firm. So the firm needs to be regulated in accordance with AFSA Financial Services Framework Regulations and rules they are under. So just to mention a few of them, those are general rules, authorized market institution rules, market rules, conduct of business rules, prudential rules for different types of firms, collective investment scheme rules, and anti-money laundering and counter-terrorist financing rules. So from ongoing conduct perspective, an investment professional needs to classify its clients appropriately. A firm must act honestly, fairly, and professionally in accordance with the best interest of its clients at all times when undertaking designated investment business. And also, firm must ensure that any communication with client or any financial promotion it communicates to the client is fair, clear, and not misleading. There are also certain requirements to the key information within the client agreement and how the client agreement should be communicated to the client. These are all requirements within AFSA Conduct of Business Rules. Also, there are two main important assessments that an investment professional needs to undertake. The first one is a suitability assessment. When a client receives an advice or the firm manages its fund or assets, the advice or such kind of management needs to be suitable for the purposes of this client and also take into account all the conditions and circumstances of the client. The second assessment is appropriateness assessment. When dealing in investment, a firm must ask for information from the client about its knowledge, experience in relation to the type of investment proposed, and assess whether such investment is appropriate for this client. Also, a firm needs to take adequate steps to protect client assets for which it is responsible for. The requirement to segregate client money from a firm's own money is aimed at ensuring that if a firm fails, client money will not be used to repay the creditors. And a firm must also take all reasonable steps to ensure that conflict of interest is properly managed between itself and its clients, between its employees and clients, in between a client and another client. So such kind of conflicts of interest need to be properly prevented, managed, and disclosed in such a way that clients' interests are protected. To support public trust and transparency, the AFSA publishes all the information on its website relevant to the activities of the regulated entities. So you may find all the information about the authorization and registration statuses of regulated entities in the public registers of the AFSA. And public warnings in relation to all the entities that breached the rules also published on the website and can be accessed by anyone. Also, it's important to mention that you as an investor or consumer of a financial service of our licensed entities may submit your complaint if needed. If a certain financial service or advice is not appropriately serviced to you, and you may submit such a complaint about such kind of misconduct or dissatisfaction with the services provided. Also, you may report to AFSA about any financial misleading advert or any unfair contract term, because every contract of our AFSA participants needs to be clear and not misleading and appropriately suited for your needs as an investor or a consumer of a financial service. So you may submit all the reports and complaints to the AFSA website, and you can visit consumer section of the AFSA website for more details. Thank you for your attention, and you may ask your questions.
Thank you very much, Ainur. I think these are very fundamental and principal concepts that regulator pays attention of in terms of consumer protection. And I think we will now proceed to our Q&A session, Ainur and Raz. I'll see if we can. We have questions from the chat. Until participants are considering to ask questions, I'll ask questions, and I think we will have this Q&A session for the next 10 minutes. So, Ainur, maybe I'll start with you, since you are the last speaker. So, the employees of authorized firms, financial services firms, are very important in in preventing, in ensuring, fair treatment of consumers and not providing a misleading information. So can you elaborate how do you assess and approve individuals for key functions?
Thank you for your question. So as I mentioned, we not only authorize firms, but we also approve individuals that perform key functions within these firms. So we have threshold conditions within the AFSA rules to assess the individuals. So the first one is integrity. So the person needs to have a good reputation in its background, in his or her background, and also have honest integrity in dealing with prior clients in conducting its business. Also, the person needs to be financially sound, so he or she cannot be bankrupt before they entering such a key function. Also, we assess the competence and capability of such person to carry out key functions. Key functions we are referring to here are senior executive officer function, finance officer function, compliance officer function, and other key functions. And also we assess the proposed role within the firm and any matters that AFSA can consider during the assessment.
Raz, may I address the next question to you? If you know a beginning or new investor would ask you, how much money do I need to start investing? What would be your response?
Yeah, that's a tricky one. You don't need loads and loads of money. There's no specific amount. It depends on how much you can afford. You can start with $100, 1,000, 200. The key is you start early, because you know whatever you have now, you can add a bit more. What you can afford, always make sure it's what you can afford, because you do not want to end up cashing it in early. Most times when you cash in an investment early, you won't really make any money, or you might not even get your original investment back. You might lose some. So start early with what you can afford and start saving. It doesn't have to be loads. Thank you.
Thank you, Raz. And how about cryptocurrencies? This is something trendy now. Is this considered a good investment?
It will depend very much on your attitude to risk. I have some, I must admit, I do invest quite a lot into cryptos and altcoins. And that is because I look at it as something that diversifies my portfolio. So there's no correlation between cryptocurrencies and the stock market. When the stock market's down, it doesn't necessarily mean your cryptos are down. So from my point of view, but I am prepared to take certain risks. So for example, if I'm going to lose $500, but I can make $5,000, the kind of risk or the reward outweighs the risk. So it all depends on your attitude to risk. But what I would say is, mainly for retail investors who do not know what they're doing, I would say it probably isn't the best investment. You really need to understand and be prepared that you might even lose all your money. If you're happy to do that for potential gain, then you might look at cryptos. Otherwise, stay away.
Yeah, I think it is really useful to understand the theories around investments, the risks and the opportunities, but generally. How can an investor learn about investing, about investments?
There are various ways of doing this. So, there are loads of investment research organizations that you could subscribe to and pay, Investopedia, Investor Place, even what's it called? I've forgotten the name, it's gone now, but there are loads of them. Marketplace, Investor Place, Investopedia. You can Google these. Now, even on YouTube, I don't discount all the people who are parading themselves on YouTube. I listen to what they've got to say. I then look at the stock or share they're trying to, and I read up on it myself. So you can just go onto Google and start with that, or read a lot of books. There are loads of books about, beginner investments, or loads of programs on TV. But the key is to do your own research. Even a financial advisor could only advise you to a certain extent. You know what you're trying to achieve. So try and read and broaden your knowledge. That's the only way you can do it.
Okay, we have a few questions from the audience. And I think this question is addressed to both speakers. So, and the question goes, at what stage did you start investing? What mistakes should you avoid? And what advice would you give to yourself if at the very beginning? So, Raz, you want to take first?
Okay, yeah. The main mistakes I made were, like I said, I looked at everything whenever it was red. I panicked initially because I didn't really understand that, well, the stock market will go up and it will go down. A typical example is I bought Zoom when it was really cheap. And then I started reading all the comments about, oh, well, when COVID-19 goes away, who's going to need Zoom anyway? The price is going to drop. And I sold my Zoom. I made a tiny profit. But when I look at it now and I think, if only I had held on to I can't afford Zoom anymore. So the main thing is do your research, have the conviction in what you're investing in. If nothing's changed, sometimes you might have a stock where the CEO leaves or they've changed their strategy and it no longer is profitable or for some reason, and you might want to exit that share or stock. But if that's not the case, just be patient. You have to be patient. But the key thing I would say is do not panic and be patient.
Great. I think Raz has responded quite extensively. May I just then direct you a second question? So, a participant asked, please tell us about your broker, why you have chosen your particular broker. So that question was addressed to you. You want to elaborate on that?
So I haven't had started investing as Raz and haven't had enough experience, but I am on my way because I understand the importance, but I take a very thoughtful steps and also gaining my financial knowledge in this respect, researching the market and researching, as you said, the brokers. So as a regulator, the first thing I see is the proper license, the activities the broker is licensed for, what kind of instruments the broker can offer to me. And I do all this research. So it's, as a first step, I think it's a foremost, it's very important to do your own research and don't listen to your friends or advisors who from very close to you, and understand your own path, what you are investing for, your needs and your wants.
That you want to take this another question. The question goes: can I, as a physical person, obtain a status of investment consultant? Where should I apply? And you may respond to that in Russian, because it came in Russian. So, могу ли я, как физлицо, получить статус инвестиционного консультанта? Как и куда обращаться?
Спасибо за вопрос.
Thank you for your question. So we need to clarify here that the AFSA participants are the legal entities. These are the legal entities that have been incorporated or registered in accordance with AFSA regulations. So the individual doesn't apply for license, but the company that is incorporated under the IFC and has been given a license can apply. So we regulate the advisory on investment, which is advising on financial products, and we issue the license for the companies. You can also visit our website where you can read the detailed information about all this process. And all this process takes place online on our website.
And Raz, I think we are running out of time for our webinar, and we still have a few questions left that came through the chat function. So we would be happy to send those to you, Raz and Ainur, by email for further responding. But at this point, I'd like to thank you for your interesting presentation. I think that our participants will find them useful. And dear participants of the World Investor Week, thank you for your interest and attending the first webinar. Our next webinar, FinTech Financing and Investing Instruments for Entrepreneurs and Investors, Debt and Equity Crowdfunding and Venture Capital in the Region, will start at 11:30. So we will see you in a few minutes.